Welcome everyone, my name is Vishal Tekshanani. I'm a senior editor here at Livewire Markets, and today I'm delighted to be joined by Josh Manning, who's the founder of Manning Asset Management and also a portfolio manager for the Manning Monthly Income Fund. Now at Livewire, we love talking to top performing fund managers, and within the Australian unlisted fixed income category, the Manning Monthly Income strategy was at the top of the class with a total return of 9.40%. Now, Josh has been kind enough to discuss how his team is navigating what he describes as one of the most challenging points of the credit cycle. And we're also going to dive into the fund's current positioning and talk a bit about private markets as well. Josh, thank you so much for your time. Welcome.
Thanks for having me.
So Josh, FY25, clearly very much a standout year for the Manning Monthly Income strategy. Can you talk about the factors that drove that 9.40% return?
Yes, I think the thing for us, this is sort of our 10th year of running this fund. What is really important is just the discipline in the investment process. So what I'm talking about there is just really the governance arrangements around that and the quality of the decision-making that's been embedded throughout that time. And I think that discipline is really important when you talk about the consistency of investment outcomes. I think that probably the misconception in this market is that getting the returns is difficult. We don't actually think it's getting assets that meet that yield hurdle. It's really around avoiding the issues. And that's something we've been quite successful at over our 10 years is assets in the portfolio not having issues that have resulted in any sort of provision or capital loss in any material way. And this year has been another very successful year in doing so again.
Now, your strategy targets a return of 5% above the RBA cash rate by investing in a diverse set of credit assets. What's the core philosophy that allows Manning to generate that consistently high income?
Sure. So the underlying investment philosophy prioritizes capital stability through various market cycles. And over that 10 years, we've seen a range of different market cycles and conditions prevail. So what's really important, as I say, is just that capital stability and then delivering an attractive rate of return, which we think over the long term will be that RBA cash rate plus 5% net of fees. So that's the bedrock of the strategy and the investment philosophy. I think from a sort of management philosophy, how we go about managing the fund, I think one thing that we've really focused on over the last few years is coupling our growth ambitions and our inflows with the availability of assets in our space that meet our risk hurdles. So what I'm talking about there is really just making sure that we're not putting our corporate growth ambitions ahead of investor outcomes and rather the other way around. So we've been taking a little bit of growth off the table and slowing that growth profile because it is a tight credit market. We're seeing some of the tightest public market credit pricing in over 20 years. We're a little bit different in the private markets, but we're not immune to that. So I think the key philosophy that's really delivered the stronger returns, particularly of late, is really coupling that growth ambition with the availability of assets, which has delivered a higher rate of return for our investors through less cash drag in the portfolio.
Josh, in your Q2 update, you noted that we're at the most challenging point of the credit cycle and there's a temptation among private credit managers to chase yield by backing inferior deals. How do you navigate risks through the cycle, particularly in the current environment?
Yeah, so you're exactly right. I mean, we're seeing a huge influx of capital. A lot of it is actually international capital flowing into the Australian credit markets, which is a huge endorsement for the asset class and obviously a great development in some ways. As a investor ourselves, that increased weight of capital coming into the sector is pushing pricing down and sort of valuations up. So that is obviously the biggest challenge is how do you navigate that environment, particularly if you believe that there can be mean reversion in this asset class and you can see spreads sort of normalize back to long-term averages, which if you buy them at tight levels will result in obviously negative or very low returns for a period of time. So as somebody who focuses on capital stability as a core philosophy, We are just having to be very careful around assets that we purchase and not being compelled to participate in some of these transactions, which we think offer poor relative value. So as talked about, we just really trying to taper back on growth and slow that level of inflows so that we can keep our more discerning lens over the asset class and keep buying assets that are true to label in terms of their expected performance over the medium to long term.
And can you talk a bit about how you're positioning the portfolio now, given the changing rate environment, tight credit spreads, and also broader economic conditions and risks?
We are still of that view, yes, absolutely. We still think private markets offer a very significant premium over public market equivalents, really because of the difficulty in accessing it, and there is obviously a degree of illiquidity in those private markets over public market comparisons. So we do still have a relatively conservative view on the consumer. Unemployment has proven particularly sticky at a low rate, but we do think there is potentially some headwinds there. And the nature of those loans versus a business loan or a mortgage is typically more unsecured in nature in our space. So these are sort of like personal loans and things like that. We do prefer in sort of these sort of more sort of less certain times, loans where there is a hard asset backing in the form of a property, such as mortgages, or a business loan where it's typically some piece of business critical equipment that we are indirectly financing through a lender. So we still have that view, and it has been a long held view. It still hasn't sort of played out necessarily, but we don't think that risk has necessarily subsided.
Lastly, Josh, for income-focused investors and their advisors who are looking at high-yielding strategies like yours, what's the biggest misconception you'd like to address, and what should they focus on when it comes to evaluating the Manning Monthly Income Fund, especially amid heightened scrutiny in private markets overall?
Well, I think from if we just take a step back and just think about that sort of market dynamic, there is a lot of capital going into the space. There's also a lot of managers being established in the space, and I think one of the key things we see is a lot of these new entrants espouse their deep credit expertise because certain members have worked at a bank before. Just because somebody's worked in a bank before doesn't mean they have deep credit expertise. And I think that is something that investors are too quick to overlook and don't query enough. So what you want to find is investment teams who have long track records in doing exactly what that fund is doing. So in our space where we are lending to lenders, or securitization is technically called, you want to find investment teams who have decades of experience through varying market cycles in doing this exact form of financing. And those people being at very senior influential levels that have seen, all types of situations and environments and know how to navigate it. So I think from an investor coming into our fund, we believe we have the most seasoned team in the Australian environment in terms of those investment committee members having that expertise, doing it for many decades for a variety of banks that have very large securitization capabilities. So I think from an investor advisor perspective, they should take a lot of comfort that we do have those in-house capabilities. But I think it's also important that investors think about what role this fund plays in a portfolio. This isn't sort of put 100% of your assets into it. There is a degree of illiquidity and you are getting paid, I think, quite handsomely for that. But if you are a very income-focused investor, I think this asset class offers a lot of merit. But I think just warn investors that it's not seen as sort of an enhanced cash or some sort of liquid. You really do need to look at it from a long-term perspective. And we've been very fortunate that the advisory groups that allocate to us have that philosophy. And I think if you do, it'll continue to be a very important and valuable part in our investors' portfolio.
Josh, thank you so much for your time. Really appreciate it.
Thanks for having me.
Well, I hope you enjoyed that interview. Some great learnings out of that conversation with Josh. If you're looking to invest in private credit markets, you really want to take a look at the way the fund manager is managing their liquidity profile, their skills in terms of navigating the credit cycle, and the experience of the team. Hope you enjoyed that interview. My name is Vishal Tekshanani. Please make sure to do your research before making any investment decision. This interview certainly isn't meant to be financial advice. Have a great day.